Good morning and welcome to Financial Accounting. Today is day 12. So this is the end of our 6th week of class, 6 out of 15 weeks. And that means that 6-week grades are going to be due next week. I believe they're due on Monday. So I know many of you are new to JCC this semester. So let me just explain how that process works, in case this is the first you're hearing about 6-week grades. So this is JCC's equivalent of midterm grades, and sometimes you'll hear us calling them midterm, but again, we're not halfway through the semester. So at 6 weeks, faculty are required to report a grade for each student in the class. So for some of your classes, that might mean that, like this class, that everything you have submitted is included in the grade. Everything is weighted as if it would be the final grade, or as it would be in the final grade as it's indicated on the syllabus. And so really for this class, and maybe for some of your other classes, the 6-week grade is if the class ended today, this is the grade you would get. Other classes may not have enough information yet to really give you a fair estimate of what your grade is. And so you might see a kind of pass-fail grade show up, and that is permitted at 6 weeks, even if you are getting a letter grade at the end of the semester. So for each of your classes, again, your instructors are required to report, and they do it 3 p.m. on Monday. So we are required to report a grade for you so that you have that early signal of how you're doing in class. And just so you know, that 6-week grade is actually the single best predictor we have of what your final grade in the course will be. So what I'm going to tell you, this applies both to this class and any other class you're taking, is next week after Monday, you should be going into Banner to check your grades and check those 6-week grades. And if you see something there that you don't like, that you know you can do better, come up with a plan for how you're going to improve. And what can you do differently to improve? And I'm not suggesting what grade you should be happy if your grade is this or that, but you know what you are capable of doing, you know what you're expecting. And if you're really honest with yourself, you also know whether you're putting forth the best effort you can in each one of your classes. So again, please, after Monday, check your grades in Banner. If you see something there that you know you can do better, or you think you can do better, but you're just not quite sure what to do about that, check with the instructor. Again, be honest with yourself about here's what I've been doing, here's the level of effort I've been putting forth for this class, and here's what maybe I can change. But don't hesitate to talk with your instructors about what you can do differently to improve your grade if you honestly don't know. I would be happy to talk with anyone in this class about how you're doing. Overall, I think grades are pretty good. I was very pleased, as I told you on Tuesday last week, with how grades went on the first exam. So for this class, everything will be included in your grade. If there's anything that you haven't yet submitted, and so there's no grade showing in Brightspace, I will enter a 0 just for the purpose of calculating your 6-week grade. Those zeros will then be removed because, as you know, you can still submit work that might be overdue at this point. So keep that in mind. If you see zeros go into the Brightspace grade book for something you haven't submitted, I will take those out after the fact. I've also noticed, and a couple students have approached me about, every once in a while, for some reason, a grade does not come over from Cengage CNOW into the Brightspace grade book. But it's not for everybody. It'll be like 1 or 2 students for that assignment that the grade just for whatever reason doesn't come over. And so I'm trying to be very diligent about catching those on my own and bringing those grades over. But if you do notice something missing from the Brightspace grade book, go into Cengage, make sure that you actually have a grade. Make sure that the assignment doesn't say resume, but it shows that it's already completed. Resume means you never hit submit for grading, so that's an important step you need to take to make sure that that grade is finalized in Cengage. And if you find a grade that's missing, or it hasn't happened yet this semester in Brightspace, but I guess it could happen. If you see a grade that's not correct, that is, it doesn't match what you're seeing in Cengage, just send me an email, let me know, and I will be glad to check that. Obviously, I do want you to be evaluated based on your real grades, not something that's missing or inaccurate. So you just need to let me know that, because although I am checking every time there's a grade missing, I'm looking in Brightspace, or excuse me, in Cengage to see if there is one. I would not likely notice if a grade in Brightspace does not match Cengage, because those come over automatically. Again, I haven't seen it happen. I haven't had anyone tell me it's happened so far, but this is our first semester in Brightspace. So, it still could happen, I guess. So that's my reminder to you, or my explanation to you about 6-week grades. Please do make sure that you check with me if you have a question on how you can improve your grade for this class specifically, or if you have any JCC in general kind of questions that I can help answer. I also need to let you know that we've had an unfortunate medical situation arise on the Cattaraugus County campus, and I'm going to be filling in for one of our faculty members for one of his classes starting not next week, but the following week. And it might just be until Thanksgiving. It might be for the rest of the semester. Does not affect my Tuesday, Thursday schedule here, does not really affect this class, but it does affect my office hours on Wednesdays, because the class that I'm going to be covering meets during what were my office hours. So if you're trying to schedule time with me on a Wednesday, you'll notice that my office hours have changed or will be changing in Starfish, where you would go to schedule with me. So my new office hours starting the week of Columbus Day, October 10th. So starting October 12th, my new office hours will be, again, the same on Tuesday, Thursday, but I will now have office hours on Monday and Wednesday only from 10 to 10:45. So it was Wednesday 10 to 11:30, the same amount of time, just splitting that time between Monday and Wednesday, because I now will have a class at 11 o'clock on Monday, Wednesday, at least until Thanksgiving. So if you're inclined to say a prayer for a JCC faculty member, please do that. I'm not going to share any more details because that's not mine to share, but please just keep him in your thoughts and prayers if you're so inclined. Next, looking at the assignments and what's coming up. So we finished chapter 5 on Tuesday. And so the chapter 5 problem, which is back to being just a regular chapter problem, should be submitted today. And then the chapter 6 pre-quiz should also be submitted today, because we're going to be starting chapter 6 in just a moment here. We will work on the chapter 6 exercises today and Tuesday. Hopefully, best case scenario is we finish on Tuesday, because we didn't have a chance to do any kind of introduction to chapter 6 this past Tuesday. It may be that it spills over into Thursday of next week, but we're going to do the best we can to stay on track with the syllabus, because as we mentioned last class, chapter 6 is the third and final chapter for exam 2. So we need to finish chapter 6 next week so that you're ready for the exam, which will be that next weekend, not this weekend, but next weekend. Any questions about any of that? All righty. Well, any questions? As I'm getting ready here to start chapter 6, any questions that are lingering from chapter 5? So we talked about merchandising operations, we accounting for purchases, for sales, discounts, credit cards, returns. We talked about perpetual versus periodic inventory systems, and that really refers to how often we update our inventory records in our accounting information system, or AIS. Anything you want to talk about still lingering from chapter 5? Okay. So in those first 5 chapters, we have really covered the foundation of accounting and specifically talking about merchandising operations, which will be the focus for most of what we do this semester. Starting in this chapter, chapter 6, and then continuing through chapter 11, we will be looking in each chapter at a specific part of the balance sheet, a specific account or type of account on the balance sheet. And so starting in this chapter and going through chapter 11, these chapters are really more standalone. So chapter 6 is independent of chapter 7 and 8 and 9 and 10 and 11. So that gives you a little bit of a break, maybe, that everything isn't just piling on top of the previous chapters. You definitely still need to understand and be able to use the information from those first 5 chapters, but you don't need to remember, I don't want to say that. You don't need to use a lot of the information from chapter 6 when we get to chapter 7. So they're more standalone than what we've done so far. As always, we have a series of learning objectives. And you'll notice that these learning objectives relate to the perpetual and the periodic inventory system that we talked about in the previous chapter. Most of what we are doing, almost all of our exercises, or the majority of our exercises for this chapter, are related to learning objectives 3 and 4. And you will notice that those are very similar. If you just change the word perpetual to periodic, they are identical. And so what we're going to be doing in the first several exercises we do is looking at how do we use 3 different methods: FIFO, those are pronounced FIFO, LIFO, and weighted average cost. How do we use each one of those 3 methods under each of the 2 systems? So you should already have a handle on what those systems are. Perpetual means it's updated every time we have a purchase or a sale. And periodic means we only update it once a month, or once at the end of the accounting period, which for most companies is a month. So we're going to jump right into our first exercise. For the most part, I will not be using the PowerPoint, and because we are going to be walking through examples of each one of these 3 methods under each of the 2 systems. So I don't need to use the PowerPoint, and we won't come back to it until we get to learning objective 7, which is probably our final exercise for this chapter. So take a look. I think that's the case. Yep. So we won't be using the PowerPoint again until the end of class, hopefully on Tuesday, when we get to that final learning objective. You can see again, we have an appendix to this chapter, and once again, you're not responsible for the information that's in that appendix. We aren't covering it in class. It's not in the homework problem. It's not in our exercises, and it will not be on our exam 2 next week. So without further ado, let's go to our exercises. Hopefully you have open in your See Now the chapter 6 exercises. If not, please pull those up now. And so we know from the learning objectives that I just had on the screen that there are 3 different methods that we're going to be learning in these exercises for this chapter. I want to give you a brief description of each of the 3. So 3 methods. And I would refer to these as inventory, valuation methods. And as you saw, each one of these 3 methods can be used in either of the 2 systems. So the system, perpetual and periodic, simply refers to how often do we update our records. The methods are how do we update them, not how often, but how do we do that. So the 3 different inventory valuation methods, and I'm actually going to give you one more as well. The 3 that we are going to cover, I'll put them in the order that we do them in the exercises. So the first one is first in, first out, or FIFO. FIFO, not to be confused with FIFA. First in, first out. These methods refer to how the assumption we make about the flow of costs through our inventory records. These methods refer to what we assume about the flow of costs through our records. It is different than, it can be different than what actually happens in reality with our product. So we are not talking about the flow of goods through our store or through our warehouse. We are talking about how do we manage this within our accounting records. And for each of these 3, what we assume for our inventory records may be different than what actually happens. And you know what? We don't even care. It doesn't matter. We're making an assumption. Doesn't matter if it's true in the real world, the concrete world of our actual product that we are selling. So first in, first out is, the idea is the first ones in. So those would be the first ones we bought. The oldest product we have are the first ones out. We assume that when we sell a product, it's the oldest one we have. Now that may not be true, but we don't care. It doesn't matter. We assume for the sake of our accounting records, when we make a sale, we sell the oldest units first. And so our ending inventory would be the newest units, the ones we just bought most recently. I want to make sure I'm doing these in the same order. So the second exercise, and therefore the second one I'm going to list here, is LIFO, which is last in, first out. It's exactly the opposite. Our assumption is when we sell a product, it's the last one we bought. The most recent purchases are the ones that we sold. LIFO means the most recent purchases get sold first. And so our ending inventory would consist of the oldest units. And then the third one is average or weighted average cost. Oops. Weighted average. And under the weighted average cost approach, every time we make a purchase, we're going to recalculate the average cost, and we're going to carry all of our inventory that's the same product. We're going to carry at the same price. So unfortunately, as I explained last class or last week, when we talked about perpetual versus periodic inventory system, we know that a perpetual system is being updated every time we make a purchase, every time we make a sale, every time we accept a return. We're updating that inventory record. Unfortunately for us, because we are doing this manually or by hand, it means it's a lot more work for us. And as I explained, the reason that companies now use the perpetual inventory system when they did not in the past is because now the computer will just do the work for us, and those computers are easily accessible and affordable even for small companies. Since we have to do it by hand, it gets a little tedious, and I'm just warning you and kind of by way of apology. I know it gets tedious. Luckily, we're only looking at one product at a time and only a short period of time that we have to analyze. You can imagine, as we look at all of these exercises, how difficult this would be if we didn't have computers. Grocery stores, for example, if you've been in, everybody's been in a grocery store, right? How many products, how many different products do they sell? Hundreds? How about tens of thousands possibly? When you look at, I mean, even chicken noodle soup, they have how many different types of chicken noodle soup and how many different sizes. So they sell many, many, many different products. There is no way that that could be done, what we are going to do here. There's no way that could be done for a grocery store without the use of computers. And so historically, companies used a periodic inventory system, where today, as we discussed last week, even companies like Dollar Tree are using a perpetual inventory system and using a point of sale scanning kind of system to update their inventory records and keep track of what they have, so that they have that comparison at the end of the period, what their accounting records say they should have compared to what they actually have. It makes it much easier for them to identify when they have inventory shrinkage. And again, we talked about that concept in the last chapter as well. Okay, so we're going to get started with this exercise. This exercise, as you can see, is using a perpetual inventory system and the FIFO method, first in, first out. So we are going to start with what happened at the beginning of November. And we are going to go through each item or each transaction, each event that occurred for this one specific product for this company in the month of November. And you can imagine how tedious this would get if we had 10 products or 10,000 products. Would not be possible. Just want to point out to you, this Exhibit 3 link does show you the way that they expect us to accomplish this inventory record. So you do have that there as an example. And we are going to be constructing a record that looks very similar to what is here. So make use of that link if needed to see what is it, how do they want me to put this stuff? How do they want it in the record? There's no magic solution here. This is not necessarily exactly what you would see in a in a real company if you had access to their inventory records. And so that's why they give us an example of here's what we're expecting from you. I am going to just leave what we have on the screen right now. I'm just going to leave it rather than scrolling up or down, because I have a printout of the information. But the information that I'm going to be sharing is right at the top of this exercise. I just don't want to have to keep scrolling up and down. So what does it tell us? On November 1st, so this was a going concern. This company already existed. They existed at the end of October, and at the end of October, they still had some inventory left. So that becomes their beginning inventory on November 1st. They had 140 units, and each of those units had an original cost of $29. So that is what this company paid for that inventory. The final column, so you'll notice that these columns appear in groups of 3. I think that's pretty evident, but just to make sure. So these 3 columns go together, then the middle 3 columns go together, and then the final 3 columns go together. So what I'm putting in this final column on the right is referred to as the extension And it is simply the units times the cost per unit. So 140 units at $29. The value of the inventory was $4,060 at the beginning of November. If we only sell this one product, that value, $4,060, is what would have showed up on our balance sheet under current assets for inventory. That's what we had available for sale when we started the month. Because we're using a perpetual inventory system, we need to go through the month chronologically. That is, in order that these transactions occurred. That is critical that we do them one step at a time in the order which they happened. And so the next thing that happened chronologically is on the 10th, we sold 110 units. Now you'll notice it doesn't give us the unit cost, and that's part of this exercise, is figuring out, well, how much do those units cost? Right now, we have only units that cost $29. We're going to remove some of those units at $29. That is not how much we charge, I hope, that is not how much we charged our customers. If we charged our customers exactly what we paid for these units, we're losing money, because that doesn't cover any of our operating expenses, selling, general, and administrative expenses. So 110 units we sold at $29. We would have added to our cost of goods sold $3,190. And now in the final columns, we're going to update our inventory. So if we had 140 units and we sold 110, how many do we have left? 30. Heard somebody say it. And right now, the only cost we have is $29. So those 30 units must be valued at $29 each. It's the only option. So at this point, because we use a perpetual inventory system, the inventory on our balance sheet is down to $870. And we have added $3,190 worth of inventory to our cost of goods sold on our income statement. Now what happened next? Well, we were down to 30 units. So somebody said, we better buy some more. And so we placed an order with our supplier for 150 units. And the supplier said, that's great. We'll be happy to accept your order. However, prices don't stay the same all the time. Most of the time, for most products, prices are gradually, we hope, going up. So the supplier lets us know that the current price is $30 per unit for those 150 units. And we say, fine, we need them. Go ahead and ship us 150 units at $30 each. We issue the purchase order. They ship the product. We just received it. We add it to our inventory. Now you'll notice in those final three columns, where we're keeping track of our total inventory, or the balance in our inventory, we now have 2 rows by November 15th. And we have 2 rows because we have inventory at 2 separate prices. And we have to keep them separate and in age order, chronological order, so that we know which ones are the oldest ones and which ones are the newest ones. Because now we have inventory, some of which cost $29 and others of which cost $30, and we need to keep them straight. Because, any questions so far? Because what happened next? We're going to sell some additional product. Now we have inventory at 2 different prices, and it matters which ones we say we sold. Which ones we say we sold will not necessarily line up with which ones we actually sold. So remember, FIFO stands for first in, first out. The assumption is we sell the oldest units first. So which are the old, Daddy? You guys?
purchase, you can record items of our stock. And you can record. See when you did the recorded the inventory in the last column.
Yes, so we record the oldest ones first and then the newest ones. Is that what you're asking? Yeah, so the newest ones always have to be after the oldest ones because we have to know which ones are older. Zim. So which ones are older here? The $29 or the $30 ones? The $29 ones. So when we use FIFO, we're going to sell the $29 ones first. How many $29 ones do we have? 30. So we're going to sell all of those. But the exercise told us we sold 120 units. So if 30 of those were the $29 ones, how many of the $30 ones did we need to sell? 90, thank you. So we sold a total of 120. We assume we sold the $29 ones, the older ones first. So we sell all of those. And then we needed 90 more from the newer inventory. So 90 times 30, $2,700. We had 150 of the $30 ones, but we just sold 90 of those. So how many do we have left? 60. We had 100, let me say it one more time. So we had 150 at $30, but we just sold 90 of those. So we have 60 left. And again, I put my extension in there, which is just units times unit price. What happened next? On the 24th of November, we sold 35 more units. Well, at this point, we only have $30 units, so that must be what we sold. We had 60, we sold 35. Maybe someone was ahead of us, and that's why I heard 25 when I asked for the last answer. So we had 60 left. We sold 35 more. That leaves us with 25. We're at a low inventory point. Somebody says, hey, we better order some more. And so at the end of the month, we get one more order, 140 units, and the price has really jumped to $34 each. So now we're back to having two different layers of inventory. We have the 25 that costs $30, and we have another 140 that costs $34. And so what's going to appear on our financial statements at the end of the month? Well, the spot where I am right now under the cost of goods sold column, we simply want to total all of those amounts that we reported as sold during the month. I'm just adding the four values in that column. 3190 plus 870 plus 2700 plus 1050. And for the ending inventory, we have two, don't add the whole column. What do we have left at the end of November? We have the 25 units at $30, which contributes $750 to our inventory value. And then the last purchase, 140 units at $34. $47.60, adding just those two numbers together, what do we have at the end of November? $5,510 worth of inventory on our balance sheet. So first in, first out, we sell the oldest stuff first. If we're a grocery store, that we certainly hope that's what's happening, right? But it's possible, you think about if you ever go grocery shopping, unlike 30, 40 years ago, pretty much everything now has an expiration date on it, right? And in the grocery store, we try to be very careful if you're working in the grocery store that you are facing the shelves and putting the oldest stuff in front and putting the newest stuff in behind it, right? Anyone ever work in a grocery store? Anyone here work in a grocery store ever? Yeah, that was my job in high school. I worked in a grocery store. And so, you know, you definitely try to be very careful about that. But you certainly have customers who come in, and when they look at the milk, they don't just necessarily grab the one in front. They're looking for the one that's going to be fresh the longest. And so maybe they reach behind and take one that is not the oldest one on the shelf. But if the grocery store has decided they're using FIFO, it doesn't matter which unit we actually sold. Can you imagine trying to, if you worked in that grocery store, trying to keep track of that? Wait, this was a gallon of milk from Tuesday, not from Wednesday. We have to make sure we relieve the inventory of the correct one. That would be incredibly difficult for a grocery store. So again, with these three methods, LIFO, FIFO, and average cost, the assumption is about what happens in our accounting records, and it may not match what happens with the actual flow of our product. I told you that there was one other method that we are not really covering in class, but I do want you to be aware of it. And that method is called specific identification. Specific identification means we know exactly which unit we sold, and that's the one we report as sold. There'd be no reason for a grocery store to do that. It doesn't matter to the grocery store which 12-ounce box of Kellogg's Corn Flakes they sold. It doesn't matter if it came out of a box dated July 1st or July 2nd or July 20th. We make an assumption, and that's good enough. So what type of organizations would use specific identification where they need to know exactly which unit they sold? Well, companies like a car dealership, it matters which car they sold because they're all different, right? So you may be a Ford dealership and you may have 5 2023 Ford Explorers sitting on the lot, but I bet every one of them is different. If nothing else, different with the option packages they have. And so it matters which one they sold. Companies that are selling unique one-of-a-kind items like antique stores or artists, things like that, definitely would be keeping track of exactly which painting was sold or which antique was sold, because they're all different, and so it matters. But for our purposes, we are going to be looking at companies that are selling lots of the same item. And so it does not matter. There's no need to try to use specific identification. Okay. So we're going to move on in just a moment to exercise 2, which is perpetual inventory system using the LIFO method. So remember, LIFO means last in, first out. We assume we sold the newest stuff and we kept the oldest stuff. Well, in this exercise, we are in what's known as a period of rising prices. So at the beginning of the month, the price was $29, then it went to $30, and then $34. Prices are gradually, or maybe not so gradually, going up. There was more than a 10% increase. The end of the month, that's kind of like what we have right now. Inflation of 8.3%. So if we used LIFO and we kept the oldest stuff, when we're in a period of rising prices, the oldest stuff is cheaper, right? And so if we use LIFO, our ending inventory would be lower, because instead of including the $30 and $34 items, it would still include all of these $29 items and a few of the $30 ones. And so under LIFO, if we had used LIFO, we would expect the ending inventory to be lower. And that's always going to be true in a period of rising prices. LIFO ends up with the lowest ending inventory. It also ends up with the highest cost of goods sold. Why? Because we said we were selling it under LIFO, we say we're selling the newest stuff, and that's the more expensive stuff. And so under LIFO, cost of goods sold would be higher, ending inventory would be lower in a period of rising prices. If prices were falling, that very unusual situation where prices are falling, if prices are falling, that would be the exact opposite relationship. And what you will notice when we get to average cost, so we've got LIFO and FIFO on the extremes, and average cost is going to be somewhere in the middle. If prices are very volatile, meaning they're going up and going down, we can't make this kind of a blanket statement. But if prices are steadily rising or steadily falling, we can be sure of what I just said. Before we move on then to the LIFO method, any questions? Okay. As I said, exercise 2 is the LIFO method, last in, first out. The assumption now is that when we sell product, we sell the newest stuff, the last in, the most recently acquired, and we keep the oldest stuff. So you'll notice that the information given in this exercise is very much the same as what we saw in the last exercise, although I don't think that one specified it was DVD players, but that's okay. And in this case, we're simply going to be using the LIFO method rather than the FIFO method. Again, I'm just going to scroll down so I can fit this on the screen and not have to scroll up and down, but you have the information on your screen in the exercise. So we're still in November, and we started November with 140 units at $29. Just like in the last exercise, I'm going to put in the extension. We started the month with $4,060 worth of merchandise. On the 10th, we sold 110 units. Well, right now we have only one price, $29. So that must be the cost of those units. Remember, that is not the amount that we charged our customers. That's the amount we paid for those units. So we had 140 units, we sold 110 of those, so we must have 30 left. Again, they have to be valued at $29 because that's the only option we have right now until we make another purchase. Slow me down if you need to, but I'm assuming that you're seeing the pattern, the flow here. So just let me know if you need me to slow down or answer a question. On November 15th, we made a purchase of 150 units at $30 each. And we need to, again, keep those layers separate and in chronological order so we know which ones are the older units and which ones are the newer units. The older ones are the $29 ones. By the way, you'll notice I keep talking about period of rising prices, period of falling prices. If you're wondering why I don't talk about periods of inflation or deflation, if you've taken economics or are going to take economics, this is something you should know. Inflation does not refer to a single product having its price increase. Inflation is a general increase in the price level. During periods of inflation, the price of some products might actually be falling, while the majority of products are rising. So it is incorrect ever to refer to inflation when you're talking about just one product. What happened next? On November 20th, we had a sale of 120 units. Here's where we see our first difference compared to the last exercise. When we are using LIFO, last in, first out, the assumption is that we're selling the newest units, and those newest units cost $30 each. we're going to hang on to those $29 ones because they're older. And so if you were to click back to the previous exercise, you would notice that that is our first difference. So we had 150 of the $30 ones. We just sold 120 of them, so we have 30 of those left. And we also have the $29 ones left. So we need to keep those layers in order, oldest to newest. It is absolutely possible that we could have 10 or 12 or even more layers of inventory over time. The older a company is, the more likely they are to have multiple layers of inventory like that. Everybody good so far? So we have 60 units now left, half worth $29 and half 30 on our balance sheet. On November 24th, we sold another 35, whoops. We sold another 35 units. Which ones are we going to sell? LIFO, last in, first out. We're going to sell the $30 ones. Oh, but do we have 35 of the $30 ones? No. So we can't say we sold 35 of the $30 ones. We have to sell just 30. And I actually think they might want these down here. In reality, it doesn't matter, but the software is going to be looking for a specific order. Actually, let's try it this way and we'll see, because those would be the first ones we considered being sold. There is no wrong order to put them in this column, but I'm just not sure which one the software is looking for. So I'm going to put the oldest ones second, because those are going to be the second thing we sell. So again, we sold 35 total. 30 of those were the $30 ones. And so we're then going to sell 5 of the $29 ones. We cannot say we sold 35 of the $30 ones because we didn't have that in our inventory. And so what do we have left? We sold all the $30 ones. We sold 5 of the $29 ones. So we have 25 of the $29 ones left. And when we get to the end and I click the check my work button, we'll see if it likes the order. The totals are correct, but I'm just unsure whether it wants, which order it wants here. What happened next? On the 30th, we bought 140 more units at $34. So now we have 2 layers, just like in the previous exercise. We have 2 layers remaining at the end of the month, but in exercise 1, the 25 units were at $30 each. So there's going to be a very minor difference, $25, $1 each for those cases. It'd be a very minor difference. But the older the company gets, the more pronounced those differences get between LIFO and FIFO. Again, average cost would be somewhere in the middle. Any questions about the LIFO method? See if it likes my order. Oh, good. Everybody's good? I'm going to show you something in the chapter 6 folder. I do have a couple of reference materials in the chapter 6 folder that will be helpful for you. We have how do we calculate cost of goods sold? And if I can. Okay. So we have a page on how to calculate cost of goods sold. So we know that this top part here is what we covered in chapter 5 at the end of chapter 5 on Tuesday. We talked about gross margin, gross profit being that intermediate or interim step in calculating operating income. And now we're learning more about that cost of goods sold piece. And so this formula that I have highlighted right now is going to be very important for us. We're going to run into this in exercises as we continue on. So how do we calculate that cost of goods sold? Well, we look at what did we have first? Beginning inventory. So if we go to this exercise, our beginning inventory was $4,060. We then look at what did we add to it? What were our purchases? $4,500 and $4,760. Those two together make up our purchases. And if we add that to the beginning inventory, that tells us how much we had available for sale at some point during the period, in this case, some point during the month. Then if we subtract from that our ending inventory, in this case, $5,485, that will give us our cost of goods sold. So that formula is going to be important for us. And one reason that that formula is important, the idea that we're actually backing into the cost of goods sold is important because in part, we talked about last class, the idea of inventory shrinkage. And I said, if inventory is missing, if we have the inventory and we don't have it anymore, it becomes part of cost of goods sold. So what we did in this exercise was we calculated cost of goods sold directly. We added up the cost of each one of our sales, right? We added all these up to get our cost of goods sold. But what we have here is probably a bit unrealistic in that we know where every single one of these items is. We either have it or we sold it. There is no inventory shrinkage in this exercise. The assumption is if we had it and we didn't sell it, we still have it. But we know that that's not always the case. And so the calculation I have here for you in the reference materials is the way that ultimately that calculation for cost of goods sold would be done on our financial statements. Because if it's not in our ending inventory, we assume it was sold. So for these exercises, exercise 1, 2, and just check here. Yeah, so exercise 1 and 2, as we're comparing our cost of goods sold and our ending inventory for LIFO and FIFO, we saw that under LIFO, the ending inventory is lower. You can see that if you just click back and forth between the two exercises, you can see that the end. Wait, oh, it's off the screen. So where'd it go? You can see that the ending inventory in exercise 1 was 5,500, and in exercise 2, it's off the screen, 5,485, slightly lower. And the older this company is, the more pronounced that difference would be. And if you look at the cost of goods sold in under LIFO, it's 78.35, and under FIFO, it is 78.10. It's a little bit lower under FIFO. The cost of goods sold is higher under LIFO because they sell the newest stuff, in a period of rising prices, that's the most expensive, right? So we can do that comparison, and as I suggested, weighted average cost would be somewhere in between those two, and we'll see that when we get to an example. Okay. Any questions so far about LIFO and FIFO? LIFO or FIFO? Okay, so what we're going to do next is weighted average cost. And I want to show you that other reference material page. A little bigger. Okay, so under the reference materials for chapter 6, you see this page, and this explains in writing what I'm about to show you in the exercise. So after class, how did she do that? What was that? Remember that this page is here in the reference materials folder, and I would encourage you to take a look at it. Okay. So here's the formula. That's the formula we're going to be using. Every time the business makes a purchase, we have to recalculate the weighted average cost. And here's how we do it. Again, I'm going to show you this in the exercise. We take the total cost and divide by the total units. That's how we get a weighted average cost per unit. Wow, it's really. This page is really wide, and I guess I'm going to have to scroll back and forth because that seems kind of small, isn't it? Or is that okay? Is that okay size? Yes, okay. I'll leave it like that then. So in exercise 3, we're going to be looking at the weighted average cost method under the perpetual inventory system. So we're still updating our records every time we have a purchase or sale. That's the perpetual inventory system. But instead of using the LIFO or FIFO, we're going to use weighted average. Unfortunately, the book didn't have an exercise that used those same data from exercise 1 and 2 for weighted average. I would have preferred that so that you could see the comparison, but it's okay. We start at the beginning. Looks like this is for a year. We start at the beginning of the year. Our beginning inventory is 9,000 units. And each of those units had a cost to us of $50. And so at the beginning of the year, our inventory had a value of $450,000. Again, that's how much it costs to us. It's not how much we're going to charge our customers. Apparently our company's not very busy, and so our first sale is March 18th. And on March 18th, we sold 7,000 units. Well, we can see the price of those 7,000 units must be $50 each. And so our cost of goods sold, total cost, $350,000. And of the 9,000 units we started with, we have just 2,000 left at $50. So we're down to 2,000. We better buy some more. And on May 2nd, we buy 8,000 more units. And the price has increased to $56.50 per unit. For a total cost of $452,000. So we had 2,000 units and we just bought 8,000 more. How many do we have in our inventory at this time? 10,000, thank you. 10,000. Okay. Here's where it's different than what we did under LIFO and FIFO, where we would have to keep the $50 units and the 5650 units separate. Under weighted average cost, as I explained at the very beginning of this class, we're going to carry all the inventory at the same price. We're going to assume it's the same thing. Why do we need different prices for it? In particular, a company might use a weighted average method if they have a product that gets mixed together. It's fungible, it gets mixed together. So think about gas at a gas station. The gas station doesn't have multiple underground tanks for the same octane gas. Obviously, they have separate tanks for the different levels of the different types of gas they carry. But for the 87 octane gas, they have just one tank. And they do not wait until that tank, we hope, they do not wait until that tank is empty to buy more gas, to have more gas delivered. So what happens? The new gas comes in and it just gets pumped into the same tank with the old gas. There's no way of knowing which is the new and which is the old. It's not kept separate, it's all put together. And so that might be a reason that a company would choose to use a weighted average method, because they're trying to more closely represent what happens with the actual product. And I told you, it doesn't have to match with the actual flow of the product or flow of the goods through our store. But that might be a reason companies would want to use a weighted average. I can tell you from my own personal work experience, years and years ago, I was the cost accountant for a refinery in Bradford, Pennsylvania. And at the time it was Kendall Motor Oil. It no longer is, but at the time it was Kendall's refining, one of Kendall's refining locations. And we used a 3-month rolling average cost for our crude oil. We did it in part because of what I just described, that the crude oil all comes out of the same tank, or the same storage facility. So it makes sense to have it be all at the same price at the same time. But the other reason we did it is, as you can probably recognize, the cost of crude oil is very volatile. It goes up and down daily. And so for our financial statements, it could really skew how our financial statements represented our company if we didn't use a weighted average to keep it to smooth out those highs and lows. So that's what we're going to do here. This company, rather than carrying some of their inventory at $50 and some at $56.50, we're going to calculate the average cost. And so this is the formula that I just showed you in the reference materials for chapter 6 in Brightspace. We added our units together already. We know we have 10,000 units. And now we're going to add our costs together. So we have 452,000 that we just bought. We already had 100,000 before that. So that would be a total of 552,000. Everyone okay with where that came from? So I added the units together and the cost together, and now I can calculate the cost per unit. We are not going to just average the prices together because this is a weighted average cost. So the fact that we had 8,000 units at the higher price means that gets more weight. So we're going to take the total cost, 552,000, and divide by the total units, 10,000, to get our new average cost. And our assumption will be that every unit we have, all 10,000 units, have a cost or a value to us of $55.20. Did we actually pay $55.20 for any of our inventory? No, we either paid 50. If the 50 was in beginning inventory, that could possibly already be an average number. We don't know. But the stuff we just bought, the majority of our inventory cost us $56.50. you'll notice the average cost of $55.20 is much closer to the $56.50 than it is to the $50, because that got more weight, the higher price, because we had 8,000 units compared to just 2,000 at $50. So it does not matter that the price we are now using isn't a price we ever actually paid for this product at all. As far as we're concerned, it's all worth $55.20. Every unit we have is worth $55.20. And it actually does make it a little easier for us, rather than trying to keep track of how many different prices do we have and which ones are the older ones. And like we saw in the previous two exercises, okay, we sold some of these and some of those, and what do we have left? We don't have to do that under weighted average. It actually makes it much simpler, because we're carrying all of our inventory at exactly the same price. And so as we go back to our exercise, our next transaction, the next event was August 9th. We had a sale, and we're going to sell 8,000 units. So how much is each one of those units worth to us? What's the inventory valuation for those units? $55.20. $55.20. Oops. And we had 10,000, we sold 8,000, so we have 2,000 left. And each one of those is also worth $55.20. Simpler, right? On October 20th, then, we're now down to just 2,000 units. So on October 20th, we're going to buy some additional units, 4,000 units, and the price is now $60 per unit. The price has gone up again. We had 2,000, we bought 4,000 more. How many do we have now? And we add the two values together to get a total inventory cost. And then we divide by the total number of units to find our new weighted average cost. Oops. And the final step, add our cost of goods sold. Again, keeping in mind that that may not be our total cost of goods sold, because there might be some inventory shrinkage that needs to be included with that. But that's what our records say right now before we do any adjustments at the end of the year. And then on our balance sheet, we would be showing $350,400 worth of inventory. Unless we have to adjust it, because now we're going to do a physical inventory and see, do we really have 6,000 units of this product left? And if we don't, we need to make an adjustment. How are we doing? Everybody okay? Anyone with a question? Okay. Okay, just want to point out the next exercise, exercise 4, is a weighted average method perpetual inventory system, just like what we just did. Exercise 5 is the perpetual inventory using the FIFO method, which we started with beginning of class. And then exercise 6 is the perpetual inventory using LIFO. If you notice, these 3 exercises are the same data, the same events, the same transactions. So now we have all three of those where you'll be able to compare the three different methods. And then well, give me 1 second here. Should have, but apparently do not. So what I want to ask you to do with the time we have remaining, we have about 25 or 27 minutes left in class. Using this time, and if needed, time outside of class, I would like you to work on these three exercises independently, because they're going to reinforce what we've just done. Make sure that you understand how to do each one of these three. Then, when we come into class on Tuesday, I will have a spreadsheet, which is what I was just looking for now, that I'm going to put in our results from these three exercises so that we can do together a comparison about what the results look like. So for all you need to do is complete these three exercises. And then when we come into class on Tuesday, we'll talk about the results. Then we will turn our attention to the periodic inventory system and exercise 7. Okay, so we have periodic inventory method, periodic inventory system, all three methods in exercise 7. We'll talk for a minute about lower of cost or market. Then we'll talk about what if we get it wrong. And finally, go back to the PowerPoint and talk about what kind of financial analysis tools do we have related to inventory. So if there aren't any questions, anybody questions? Okay, I'm going to stop the recording for today then.